It's a concern, but it's not a new concern. It's something that tensions over possible trade war have refocused investors' attention on. It's refocused the attention of domestic investors in China as well. And that's why you see the downward pressure on the stock market, particularly the domestic stock market in China. But these are long-standing issues: overinvestment, overdependence on credit expansion. They went away, or seem to have gone away, a year ago because China, because of the Party Congress and Xi Jinping consolidating power, they pumped a lot of money into the economy. They boosted the economy for a little while, but it actually just dug the hole deeper, and now we're seeing the after effects.
I guess my question really is, on a relative basis, how much more concerned are you at this point? The more you see the Shanghai Composite go down, the more you see the yuan weaken against the dollar, the more you see that the Chinese government isn't able to do much to prop up its stock market through the national buying team, or to employ measures that will actually juice growth, as we've seen in recent PMI numbers there.
They've kept digging the hole deeper, and it's become a larger and larger concern as time has gone on. And like I say, the prospect of a trade war is just one more straw on that camel's back.
I read a really shocking statistic, and maybe it's probably old to you as a China watcher, Patrick, but that 11% of China's market capitalization is put up as a collateral for loans, which is troubling in an environment where the economy is deteriorating in China and people may be forced to sell. So how much more of a downward pressure could that be, do you think, on the markets there?
There has been a debt explosion in China over the past decade. After the 2008 financial crisis and the stimulus that they used to respond to that, which never really ended. And so that has continued to be an issue. The thing that's weighed against it has been the willingness of the government to step in and essentially guarantee to socialize debts. And if something even hinted at being a systemic risk, then the government would step in and backstop it. And whether or not the government can continue to play whack-a-mole is a big question.
So, Patrick, we get numbers later today, Friday, Shanghai or Beijing time, that suggests the forecast is that the economic growth is going to slow from 6.7 to 6.6%. Will that number, whatever the number turns out to be, will that number tell the story, or will it mask what's really going on behind the curtain?
Yeah, I really wouldn't look to that number as a true indicator of the, what will be portrayed as a gradual, decline in the growth rate. In fact, what I would look towards is things like what kind of pressure do we see for capital flight from China, and that's reflected in the downward pressure on the yuan. What kind of investment growth rates, both public and private, because the boom that we saw last year that got everybody's hopes up that China was back on track really came from injecting all this credit in and then boosting those investment numbers. But now that that stimulus has gone away, we're probably likely to see that investment driver recede again.